Okay, just to run through exactly what we would do in terms of an end of week forecast, preparing for the week ahead, and then we can kind of look through the week in regards to how it kind of played out and what we would be looking for in terms of trade entries, market structure, inefficiencies, and all those type of things of where you would kind of be confident taking trades according to how I kind of analyze and look at things at the moment. So obviously we want to initially start on the higher time frames. If you haven't already done your analysis, you'd kind of want to go down from the monthly to the weekly and the daily, and I'll basically explain that as well. But what I'll do is initially we'll put a line as to where this week started. So we've got the 13th here. Yeah, okay. So what I would normally advise is that you'd go to the monthly, and you'd want to start seeing exactly what market structure is telling you in respect of certain zones and areas that you should be targeting. Okay, and we can see here clearly that, you know, because it's a very high time frame, the market is obviously very bunched up, but you can clearly see that there's still a bearish momentum taking place. So from 2014 onwards, we're bearish. The market tries to come up. It tries to basically take a previous structural point, which would have been this high here, and it continues bearish. And it has remained respecting the highs that it created since it basically printed this bearish structure. So this is one structural point. This is another structural point. This is another structural point for us on this time frame. So we can see that all the points are below each other, which means that the market is respecting the trend that it's kind of forming at the moment. And our initial note or mental note, and you can even put, like, some people do type onto here, so they'll say like monthly bearish, okay, and that kind of jogs their memory in regards to where the market is on a higher time frame and where the market is on the lower time frames, because it can get confusing when you start looking at it on the lower time frame. The market looks bullish, but you need to also understand that in the bigger scheme of things, the market is still bearish. Okay, so we've kind of established that the market is bearish at this point. What we would then do is kind of look at the initial moves closest to us in the previous 5 or 6 months, and we can see that it's a bearish trend. So what's happening here is you've got a high point being tested. That point gets tested again, it gets liquidated. It's still respecting the previous high. So, I mean, what happened here is, if you have any questions while I'm saying things, please jump in and I'll try and explain it. We can see here that this high has been liquidated, okay? Now, a lot of people would think that, okay, the market structure is now broken bullish. That's not the case. The point here is that any orders that were placed here as sells took advantage of this wick tapping into a previous area of supply and inefficiency on this wick. So these were all sell orders that people were trying to basically buy the market down from. And as the market's brought down, it's kind of done exactly what we look for on the lower time frame, where it's kind of moved away from the zone, going towards sells. It retraces, but then what it does is it liquidates out everybody that got involved at this point before it then actually makes the intended move that it wanted to go bearish. So the initial move from this point here, if you got in at the top, would have only been a 57, 58, let's just call it a 500 pip move, 575 pips, okay? Now, that move gets liquidated here, but this move now overall is in excess of nearly 900 pips. So this was the actual move that the market wanted to create. It duped people at this point by bringing them in, letting them see profits for a couple of months before retracing back and taking them out at their entry, if they didn't set their stop loss above this. Now, again, on the higher time frame, it gets a bit confusing because you would mark this entire area as an inefficient zone, but that's 300 pips in itself because we're on the monthly time frame. What you want to do is you see reactions off these zones, which we'll get into later on, and take the trade as it taps into an inefficiency and shows you rejection on the lower time frames. Okay, so we know that on the monthly, we're bearish. Then we go down to the weekly and we see exactly what's happening on the weekly. And one thing that took me a long time to kind of understand is you need to also respect that whatever you see on any time frame, it's only a refined view of what you've seen on a bigger time frame. So the monthly shows us this wick with this area being liquidated. On the weekly, it's exactly the same. So we've got the wick and we've got the area being liquidated, but it happens at a different point, which is not going to show me. Okay, it's not going back far enough for us to see that, but effectively, whatever, this is what people say when they say that the market is fractal. Whatever you see on the higher time frame always happens on the lower time frame as well. And it's not letting me show those icons for some reason because I think it's not going to respect the time frame. So we can see even on the weekly we are bearish, and this is where people get confused. So they'll start looking at the monthly time frame and they'll see that these markers are put in. Okay. When you then go to, I don't know why they're not displaying on the lower time frame. When you go to the lower time frame, those same areas are still visible here. Okay, so we've got the high, we've got the high, we've got the high. Okay, and it's still showing you bearish trend. And you also want to kind of do this on relatively higher time frames because it shows you the intention of the market and which direction it wants to go in. With all of these moves in the middle, you'll get confused where market breaks structure here, thinking that, okay, the market's now going bullish. But in reality, it's a complex pullback to continue bearish, which it has confirmed at this point here, where it respects the high that's been created previously. Okay, so you could possibly even get involved in bullish trades, but bearing in mind that the market overall is still bearish. So you're not going to be expecting, you know, this move to do this, because you want to see it respect the overall trend, which is bearish for us at the moment. If it breaks this high, that's when we then want to change our bias and start looking for the buys. But until it doesn't show us this on a higher time frame, we're going to stay with whatever trend the market is printing. So again, here on the weekly, I'll go back in and just to remind ourselves that the weekly is also bearish. Okay, so we can see that what's happened is the market's come up. It's done exactly what it did on the higher time frame in respect of it creating a high, pulling away from that high, breaking structure on the lower time frame. Then it retraces and takes people out that got involved too early, liquidates them at this point, which is a difference of 8 pips. Okay, took them out and then created the move to the downside. So here we are still respecting bearish structure. At the same time, what you will also see are supply and demand candles. Okay, so this is a supply candle, which obviously caused moves to the downside. And at every point that these occur, you'll see some form of a reaction. But the major reactions always occur at places where you have high volume moves. I'll explain that to you as well. So, okay, so we can see that we've obviously got a supply candle, which is a move made to go bullish, but the intention is to go bearish. So it again liquidates people out, takes this high, because people think that the market's consolidating here and now it's going to move off really aggressively high. It takes these highs out and then it moves bearish. And this is a high volume move because bear in mind it's on a weekly time frame. Now all of these imbalances and gaps in the market need to be filled at some time or other. They have to be filled. This is what we need to keep reminding ourselves. And the smaller the gaps are, the better it will be for you because you'll minimize your stop loss. Okay, so for example, this area here where we have an inefficiency or a supply candle, we can see that it's a 15 pip area. Okay, but we can see that any point where we have a supply or demand candle, the market always reacts off it. And it may not basically break structure, but it will definitely show a reaction. And even when it comes back and it breaks structure and returns to that point, it reacts off it again. So there's clearly a high volume of orders in here where people are continually, all of these locations here, everyone's been like selling, because they think that the market's moved off bearish, it's coming back retracing, and it's going to continue to sell. So all of these orders are just like sitting here, okay? And what the bank's done is they basically made people believe that the market's selling by creating even this major push here to break structure to the downside. When it comes back up into the area of interest, it again gets additional orders put in, only to then reverse and then take them out. Okay, so the banks and the markets are always in a battle of buying and selling. And all they're trying to see is that which side is stronger. That's how we need to see it. It's a battle between the buyers and the sellers. But at the same time, it's also a tactic of making people get stopped out. So we need to look at legitimate areas where there's a good point of entry, which is an area where there's an up candle to create a down move or a down candle to create an up move. Now, the type of moves that we're looking for are things like this. An up candle to make a very large down move, which shows there's a lot of volume in this area, and this type of area, which shows that there's an up candle to make a large down move. These type of moves that occur, we're not interested in these at all, because the market's not moving enough, and it shows us that there's not enough volume in the market to have an impact here. And we can see that when the market came back to test this area, it just completely disregarded it. It bottomed out and then blew through it. There's no retracement from this area because there's very small orders that are going in here. Whereas here, where we have large candles and gaps in between, which shows you that there's orders that have not been fulfilled. There's people that are trying to sell, and there's not enough buyers to keep the momentum going up. You can see that the market comes back and it has to fill in all of these gaps. And in the area where it created the big move is where you see the reaction to then continue bearish. All other areas that are intermediate areas, you can see that the reaction is there, but the market then always returns back from it. So what we're looking at is higher time frame supply and demand zones that will be a means of creating a bigger reaction for us. So this is the initial move down. All of this stuff in between, it's noise. We can forget it. The only things that we're interested in is this move down, this move back into that area of interest, and now the move down back again. That's what we are anticipating as a long-term trade. Now, there's a lot of trades that could be had in the middle, but if we got in at these points right now, we could be holding this trade from May 2021 and we'd still be in profits. And this is what I try and achieve, getting into the higher time frame moves and holding those trades long term, because you can take profits off along the way, but you're consistently in profits until the market shows you otherwise. Okay, so that's the weekly time frame. We're bearish. I just wanted to go into a bit of detail how you can do the analysis on every single time frame. And it's the same as you continue to go down, you'll do the same thing that I've done for you just now. Okay, so we'll get rid of the information that we put on this, and we'll take it down. Actually, I'll leave it on. I'll create a folder for this and just label it as weekly, so we can see how they kind of overlap. So from the weekly, then we go down to the daily. Okay, and now we can see how the points on the higher time frame and the lower time frame, so the monthly and the weekly, are correlated. Yeah, you need to obviously be able to visualize this, because as you get down into the lower time frame, there's a lot more noise, and you'll sometimes get confused, which is why a lot of people, they do put these markers on. I fortunately now don't need them. I just kind of visually know where my guide should be, but if you put these marks on it, it gives you confidence that the analysis that you've actually initially thought of stays valid, because we can see here the market's tapped into an area of supply and it's rejected from the higher point and it's continuing bearish. So when we get down onto the daily chart, we see more of what type of moves the market is making between the weekly and the daily. So it's the same type of move. The market breaks away, comes back in, retests that order, and takes out the buyers that are here. So people that would have been in a profitable trade for nearly 3 months, they get taken out at this point. Okay, so this is why people say that as you basically have your trades running, make sure that you take profits off during the trade being played out. So what people would do is you'd kind of have a few different points set. Some people have a set rule of 1 to 3 as a profit take, and then you have other areas which can be taken like specific lows, structural lows, and then you can just leave one trade that just runs, you know, as long as you think that the market would actually go to. So if we actually were in the trade at this point here, we would really be targeting this zone down here. Okay, and that would be a 1 to 45 with a 55 pip stop loss. But I mean, it can be refined down as you go down into lower time frames, and we'll go through that. We'll leave this on the chart just to see how that could have actually been refined. Now, we would actually have waited for our confirmation to take place before we would have taken our trade here. And the reason that we're doing that is, no matter what time frame you look at it on, if you get a confirmation on the daily that the market is breaking structure, which we can see here, the market's broken structure at this point. Okay, lows have been taken. This is a down candle for the up move. So once this zone gets taken, we know that the market is intending to go bearish. Okay, and we can see that it gets tested here with this wick. It moves away from the zone, but then it blows through the zone. So we then know that the market is bullish and it's not going to now break highs. Okay, so you could have actually got in on a trade at this point here as well, where the market broke down and it came back up to test. We could get in on a trade here. We could set our stop loss above the previous high that was tested. That's a 12 pip stop loss. And you could have basically been in very healthy profits at this point here, 1 to 25. You could have taken off at this zone, which again was a down candle for an up move that broke structure, as a take profit margin. Okay, but what the market does is it actually breaks down, it returns back to entry, takes out the orders, and then it starts breaking down again. So what you need to understand is there's two ways to analyze the trade. This is an aggressive entry. So where we see the market come into our zone and it starts to then reject from that zone, one of the ways that we can actually enter is by using the 50% mitigation rule, which is that if the market kind of taps into 50% of a previous inefficient area, which on this specific chart on the daily, you'd be looking for nearly or close to 50% mitigation. Okay, so the market's told us at this point here that it can't get up any higher than this area that is created. When it starts to reject from here, we could actually take our trade at this point. Okay, and we would do that on the lower time frame. Again, this is one strategy, which is an aggressive entry. So when the market starts to reject from tapping into the zone that we're monitoring, we can see that it kind of comes up, it taps in, rejects off, pulls away, again breaks structure on the higher time frame, which is the 4 hour now. It pulls back into the area where it kind of made the move from, and we can see here that the 50% wick has been taken on the lower time frame, whereas on the daily it's showing us that it hasn't been taken. It's close to, but what we need to understand is there's an overlap here between the daily chart and the 4 hour chart. So the 4 hour chart is telling us that the market has taken 50% of this zone, which we would be expecting for it to then create the move. So it takes 50%, breaks away, comes back in, tests 50% of that wick again. So we're looking now for this to be taken. Okay, it gets very close to the 50% again, and then it breaks away. So our entry would really have been at this point here, and we would have set our stop loss at this point here on the daily chart. Okay, and this trade would have then run, and we would have been taking profits along the way, 1 to 7, 1 to 10, 1 to 13, and then possibly testing this zone, which is what it actually reacted off again to go back the other way. Sorry, I'm just going to take this call. Give me 1 second. Okay, go ahead. No. So you'd actually want to have your monthly and weekly zones marked up as your initial analysis. Okay. Once you've done that, then you'd only be looking to monitor things on a daily basis. So once the monthly and the weekly are marked up, you leave them on. Because what you'd want to then see is when the market comes into these weekly and monthly areas, how it reacts on the daily. And then when you see it react on the daily, you then want to go down and see how it reacts on the 4 hour, which is kind of what we've done at the moment. Okay, so our weekly area that we were looking at was obviously this area of interest, which is the weekly supply candle. Okay, when the market tapped into that area at this point, we then will be notified on the daily. So it taps in on the daily, we're then watching this zone, okay? And we're watching for the market to come in and test 50% of this zone, okay? When it takes 50% of this zone on this candle here, which is the 24th of February, we then would then go down on this candle to the 4-hour chart. So what I'll do is I'll mark up this candle and then we'll go down. Right, so that's that point. Now it's taken 50% of the daily wick that we wanted it to at this point. Let's just make sure that I'm at the right place, which is this one here. Okay, right, so the market comes in, it taps on this 4-hour, the 50% that we were looking to get mitigated. Okay, what it then does is it shows us. Now, one thing that you also need to realize is that for the market to come and mitigate an area, it needs to then continue mitigation to show us that it doesn't respect that area. So what we would be expecting to see is you'd want this to come in at this point, come up, and continue up. The second that it shows us that it does not want to continue going further up is a clear sign that it's reached its peak at this point. Okay, it's showing us right now I can't get above this point. So what we then start doing is we start looking for an area of interest below that level. Now, the inefficient level within this candle is the wick, because the market opens here, it goes down, it goes all the way up, comes back down, and it closes here. So this area has been satisfied. That's why it's a candle, because all of these orders has been filled. These orders that are left behind on the wick have not been filled, which is why the candle didn't close up here. Okay, so wicks are inefficient areas. The bodies of the candle are the filled orders. That's how you also need to look at it. Okay, now we're looking for a bearish momentum, which is what we've analyzed from the monthly and the weekly. So our most discounted level is this area. So if we want to sell, we want to try and get as high up on this wick as we can to then start selling, because that will be the best price to buy things at to then sell and get the most profit. So we want to get as close as we can to this inefficient area, which would mean that we're only targeting the wick at this candle. Once it starts to reject, we can enter anywhere within this area. But the confirmation that we look for are multifold. Okay, so here, this is the initial. I mean, you guys might want to make a list of this as well. The initial confirmation that we look for is the tapping in to the area of interest, which is what this weekly supply candle was for us. Okay, the second confirmation that we look for is we want to see 50% of that area get mitigated. Right, so 50% of that area gets mitigated. Then what we want to see is we want to see rejection from that area on the lower time frame, which we see by these candles that are formed after the 4-hour wicks into the 50%. It starts pulling away. It shows us a reaction from that area for the market to then react off. Okay, so we've got rejection from the 50%. Now what we want to see is a break of structure to the downside. Now that can be viewed in multiple different ways. It depends upon how you view the chart. Okay, now for me personally, there's multiple areas I could say the market has broken structure here. Okay, I could call this a break of structure. Other people would say, no, I'm going to call this a break of structure. And other people might say, no, I'm going to call this a break of structure. Because it depends upon where you're viewing your pivotal points on this time frame now. Okay, people might be saying, okay, this is my high, this is my low, this is my high, this is my low, this is my high, this is my low, this is my high, this is my low. And then this high, when this high gets created, it shows you that it's respecting the previous high. So you're like, okay, the market's going bearish. Okay, so again, it depends upon how in-depth and complicated you want to make it. If you want to make it very easy, then you can just wait on the higher time frame for this move to happen all the way down and then get rejection. So the criteria that I'm giving you, you can use it in multiple ways, and we'll go through that in a minute. So what we've said is that it taps into the area of supply, it starts rejecting from the area of supply, taking the 50% of that area. Then for an aggressive scenario, which is scenario 1, we look for 50% rejection of the wick that basically caused the break to occur. So as I said before, we're looking for 50% of this wick to be taken, or close enough to it. And we can see here it hasn't taken 50%, but it's very, very close. And what you need to also factor in, if it doesn't take 50%, there's always a reason for the market to come back here, which we have seen happens. Okay, because it hasn't taken the position as fully as it needs to completely disregard this now. There's still some orders left behind that the market needs to collect because the 50% hasn't been taken. Okay, so when it starts to reject from 50%, here, 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 and here, we can take entries at any of these points because they're all below the 50%. And these would be aggressive orders. So our stop losses would be either at this point, 25 pips, at this point, 60 pips, or at this point, 115 pips. But bear in mind, we're on the 4-hour chart and we're looking at a weekly zone. Okay? Yes. Yeah, so what some people do is they basically, when they see this rejection and this wick then does not push up, they will enter here and they'll set their stop loss there. I would never do this because the stop loss is too large. And there's no point holding an order like this. Okay, so what you'd want to see is, let's take this down to the lower time frame. Okay, let me go through it with you guys on the 4-hour first to show you how you can just use the 4-hour. Don't worry about going any lower. Okay, so now the daily we looked at, we know what's happening on the daily chart because we see that it comes into the area of supply, it moves away, causes a break of structure, which shows us that it wants to go bearish, comes back in, tests the area of supply again, liquidates people's orders, and then creates the move. Okay, this is what we're looking for. Just blueprint this into your mind. We're looking for this to happen. We're looking for entry into the area of interest, break of structure, retest, and then move away. Okay, this is all you need to think about. Now, there's a number of different variations to this, and I can't explain everything to you in one video, and there's also justification as to why this high is also taken. It doesn't need to respect the highs if it's creating a move. Because understand, the market works in multiple different layers. And one of the layers that it works in is supply and demand, which is buying and selling. The other area that it works in is liquidity. It basically needs fuel to be able to go in a direction. And that's exactly what's happened here, where you can see the dotted line. And some people say that, yeah, but why is it going bearish when it's broken the previous high? It has broken the previous high, but understand, in the bigger picture, it's respected the higher time frame high behind. Okay, so this level is still respected. This move here is just picking up all of these orders that would have been sitting in here to then create this move to the downside. Okay, so you're looking for this to happen on the sell side, and exactly the same thing to happen on the buy side. So we're looking for it to come into our area of interest. Let's say it's this. We're looking for a break of structure to the upside, and then come back to test this area and then move away from it. These are the two scenarios you should be looking at for now. Okay, entry into an area of interest, which is a supply or demand candle, break of structure on the lower time frame, which you can see here as well. Okay, entry back into that area of supply. Doesn't need to get all the way up to the entry all the time. It can kind of move from an area of inefficiency as well sometimes, and then that creates the move. Okay, so on the 4 hour then, what we'd be looking for is this move starts to happen. Okay, scenario 1 we've gone through, where we look for 50% mitigation and we get in on the aggressive entry at this point. Okay, so this is our aggressive entry. We're in here, we set our stop loss there, and we leave this trade running. Okay, so we could end up with a 1 to 15, 1 to 14 trade here, comfortably taken off within a couple of days. So this trade moves, okay, 1 week. Okay, in 1 week, we've got a 1 to 15. We take that position off, we leave one trade running, and that trade then goes to break even. Okay, the market then plays out. This trade is continually in profits, and it stays in profits all the way until the market comes back and tests itself. So this trade is still in profits until this point. Okay, so we can see that we could have taken our profits off at any time in this whole period of 80 days. And we would have constantly been in profits. Now it depends upon you where you then take the profits off. You could take them off when it comes back to the lows that you created and you took 1 to 15 off, or you could continue to move this lower and take it off at areas that you also would be monitoring on the lower time frame that caused moves to the opposite direction. Now we can see here what's happened. You've got a down to up move that broke structure here. So this is an area of interest, and we'd be looking to target this as probably a long stop sell target. So we've got what I would personally have done. We would have taken profits off at this point, at this point, at this point, at this point, and this point. And if you go in with a very heavy position, which some people do, of like 20 or 30 lots, you take off 10 lots, 5 lots, 5 lots, 5 lots, and then the remaining 5 just stay open because you've taken your profits off along the way. And this is just a risk-free bonus trade. And this is how you basically partial along the way. Or you could take 5 positions here and take them off as they reach your targets, one after the other. But you always break even once you've got your first position, because you want to protect your capital. Don't leave them open with SLs all the way down to here, because the market could very easily come back and take you out. Pay yourself every day. That's the motto as well. Okay, whatever trades you decide to take, whether they meet your criterion setup, pay yourself every day. Take off your $500, $1,000, whatever you want for that day, whether it's a 1 to 3, 1 to 5, 1 to 10 position. Take off your profits, so at least you are in profits for the day. If it continues to move over a long period of time, all the better, because you can continue to just take your profits off. Okay, so what happens on the 4-hour chart? The market comes down, it then moves away from our intended bias of continuing bearish, and it starts to reverse. We're not bothered. Okay, don't worry that the market starts to eat into your profits, because we've already taken profits off at all of these points on the way down. We're probably sitting at about 1 to 60 odd R in profits right now. So we've got, like, say 10 grand in our bank. We might be seeing on MP4 that the profits are going from 10 grand down to 1 grand. We don't care, because that money is not for ours to be had. We've taken what we needed, and now we're going to see what the market shows us it wants to do. And this is where you need to control your psychology and your emotions. Because when you see the MT4 on your phone or your computer showing you, damn, it's gone from 10 grand to 1 grand, what am I going to do? What am I going to do? Don't worry. Because if you're managing your trade properly, you've already taken your profits and you're just waiting for the market to show you what it now intends to do. So what does it do? It comes back to our entry and it takes us out. No problem. Okay. Now what we're looking for is we're looking for this same scenario to play out again, because we already should have in our mind that, look, the 50% was not taken when the market started to move away. So I'm still targeting this 50% to come back. Okay, so we're still looking for this 50% to get taken. And what we would do when the market comes back and takes us out of our trade, we then start looking for that same confirmation again. We're not going to go in heavier than we did before. Our trade plan should be consistent in every single scenario that we take. So we've taken 1 to 20 on the trades that we played out over the past week. This is a new week, right? But the set scenario is still active. We're still looking for sells, and we're still looking for the same risk to reward, and we're still taking the same trades that we did last week. So what we would do, the market comes back in, taps to 50% again, rejects from the 50%. We could have been in a trade here, okay, on the exact same trading plan that we've just discussed. Why? Because the market's come back, it's taken 50%, it's taken this wick, it's broken up, but then this candle is showing rejection, and it shows rejection from 50% of the wick of the candle before it. So we could have been in on this trade here with our stop loss set above that wick, which is a 5 pip stop loss, and we let this trade run. Okay, exactly the same scenario. We're targeting whatever we've got in our trading plan as our take profit margins. Okay, you could again have your 1 to 3, have your 1 to 5, have your 1 to 10, and then leave one running. Okay, so what happens is this trade plays out 1 to 7, 1 to 10, 1 to 15, and then we leave one running. Okay, so that goes to break even. Now the market does exactly what it did to us before, no problem. Yeah. No. So what you do, you need to activate one-click trading on MT4, and you need to activate one-click trading on your MT4 app. I don't know if you know this. So if you go into MT4 on your phone, okay, and you open the app, you click any pair, and you click chart. Okay, when you go to the chart and you turn your phone horizontally, you should have 2 buttons on the top left hand side, buy and sell. Okay, now that activates one-click trading. Now what I do when I want to take very quick orders in succession of 3 or 4 or 5 trades at a specific point that the market is, and I don't have time to go in and put all the figures in and all this and that, you can see on your phone now that you've got the buy and the sell button, and you've got the prices shown above those, and then in the middle you've got a box that basically has a figure in it. Okay, that is your lot size. So what you need to do is you need to go to a lot size calculator and decide what risk you're going to be putting on your trades and how many pips stop loss you're going to be initially starting with. What I always advise people is initially start with like a 10 pip stop loss as across the board, regardless of whether it's showing you 5 pips or 7 pips or 10 pips. Use 10 pips across the board, okay? And set your lot size according to that, and just put it into your MT4 like this. If you click that box, it will allow you to then change that figure. Okay, so I automatically have all of my charts set up with the figure that I need it to show. Okay, so I know that when I click buy or sell, it's automatically going to place a 0.25, 0.5, 1% lot for me. Okay, and you can click this a few times very quickly and it will place the orders. Then what you need to do is you need to then go into the trades individually and set your stop loss afterwards. So the thing that we want to do is we want to get in on our entries, right? So when the market starts to move away from this point on the 1 hour, we're already in this trade. Where did it happen? So we've got this. That's where it got wicked out. Yeah, okay, so that's where it got wicked out. So we were on this trade, okay? So what's happened is that the market's come in, right? It's come and it's tapped very close to our 50%, and we get in on the trade here. We click that button 2 times. Bang, bang. The trade's open. Okay? The market then starts to move away from this area. It starts to retrace like this. It starts to move down. Because it's taken what it needs and it starts to move away. As it starts to move away, we're not bothered because our entry is here. And we want the market to respect this area. So even if the market then kind of draws up slightly into this, our stop loss is still way up here. So all you need to do is when you enter the trade, and then a few seconds after that, just go into the trade. And when you go into the trade, you click on the trade and you click modify. And then you see the stop loss you've got marked up here, and you put that in as your stop loss, and you're safe. Yeah? So the market's not going to move aggressively on this time frame. When you go down to the really lower time frames, like the 1 minute, the 5 minute, the 3 minute, it's going to move crazy, which is why I advise people don't place trades on the lower time frame, because there's so much that happens in this area for the market to even get up into this point. So you should be able to place trades on the 1 hour using this exact strategy that we've spoken about. And 5 pip is a very, very reasonable stop loss. It's amazing for some people actually. Yeah. And you could kind of use this to manage your risk. And as we said, we come back in, we take our profits off this trade. As it develops, it comes back and takes us out again. Okay. So the market takes us out again at this point. No problem. All we're going to be doing is waiting to see what the market shows us again. So it comes back in. Yeah, sorry, go on. Yeah. No, you have to take profits with the lot size being reduced. So the only way that you can do it is, for example, I can do this in 2 ways. Let me explain to you. We've got 3 trades here. Okay. Let's say we've got 4 trades. Okay. Each of these trades are 0.25 risk. Okay. So I could take profits at different points with each of these trades. So for example, forget about what the stop loss is saying right now. This is one trade and it's exactly here. It's here already, right? I could decide to take profit on one trade at this point. When that trade gets taken, I take 0.25 lots off. At this point, when the market hits, I take 0.25 lots off. At this point, I take 0.25. At this point, I take 0.25. The only difference between these is that the profits will be different. It'll be $100 here, 125, 150, and 200. Okay? Or what I could do, I could enter here with a 1% risk, which will cover all 4 of these positions, and then I can take off a position at this point. So I can't explain to you easily because we haven't got an active trade at the moment. But what I will do is, I think I have a video saved which shows how to take a partial lot. So if this is 0.25, 0.25, 0.25, 0.25, that all together is 1% risk. Okay? Which will be like probably a 15 lot trade, and that's split into 4 trades. I could take a 15 lot trade as one trade, but then at this point on MT4, when you go to close position, you can actually change the size of lot that you want to close in exactly the same way that you place the trade. So when you go to modify or you go to close position, it opens up a panel. You can click where it's got the lot size being 15 lots and change it to 5 lots. And it will show you that you're only taking off 30% of the profit and you're leaving the remaining 66% running. And that's what I do. So I enter an aggressive position here and I'll take off 5 lots here, 5 lots here, 5 lots here, and then leave the rest running. Yeah, that's called partialing along the way. So you take off a partial lot, okay? And that's probably the smartest way to do it because you get to the required profit level that you want for the day very quickly, rather than waiting for one position to play out and then leaving the other 3 smaller lots running. You could take $500, $1,000 very quickly and then leave the rest of it running. Okay, so what happens here, the market comes down, it broke low, it came back and it took us out again. Now let's go to scenario 2. You could continue to repeat this again and again and again until the market doesn't break structure. Okay, and when I say market break structure, the only time that we would regard the market as having broken structure is when this level up here gets taken. Until the market gets to this point, we're still going to be looking for sells, because this is the high point on the higher time frame that created the move to the downside. And until this is respected, the market is bearish to us. Okay, so yeah. Yes. I started like this, yeah. So I basically got myself very comfortable just by looking at these higher time frame zones. So literally like the weekly and the daily. I was waiting for the market to come to those zones and take those trades, because I was also learning how to refine my entries by doing this type of a thing that I've shown you, waiting for it to get to the 50%, checking the rejection. And I initially started with what I'm now going to tell you is scenario 2, which is the confirmation scenario. Okay, the confirmation scenario is we could wait forever for this to play out. Okay, and I'll be honest with you, this isn't the best example to show you, because this also has an additional element attached to it, which it's called a liquidation of highs, but it's still the same, right? What we look for in scenario 2 is we're not going to take the trade until the market confirms to us what it intends to do. And what does that mean? It means that we want to see this actually happen on the lower time frame. Okay, and it can happen in a number of ways. We saw it happen here where it broke down, came back, wasn't able to go higher, so we entered at this point. But the more conservative approach would be that we wait for the market to break down, show us it wants to continue lower, pull back up, and now we enter in this area, because we're more confident that the market is going to move away, because it's shown us that it's already breaking structure to the downside. Okay, it's taken, if you look at it even on the 1 hour, it's broken so many areas. Okay, so it's taken this low, it's taken this low, it's taken this low, it's taken this low, and it's taken this low. So it's showing us that it does not respect areas that have been printed in the market for it to continue higher, and it's now testing and wanting to go lower. So when it does that and it comes back into an area of interest again, so our area of interest would be 2. We're looking at the higher time frame, which we're going to leave on the chart. The second area of interest is the inefficient area that it created to make this move. Okay, which is the wick of the candle that caused this break of structure. So we're now also targeting all of this to be tested. And this is our lower time frame confirmation now. So the market moves away from that area, moves away, comes all the way back, and it starts to test the area now. And what we would be looking for, let's disregard this, because I'll explain that to you guys within this as well. Right? It comes back in, it takes 50% of the area again, and it starts to reject from it. We could be in on trades here again, right? This is scenario 2. This would be the first time we enter this trade using this setup, where we're looking for a break of structure on the lower time frame, and for it to come back and then sell out of the inefficient zone that broke structure on the lower time frame. Okay, so we set our stop loss above the previous wick. That's taken the 50% of this zone now, and we can see that we could have had profits to 1 to 10 in this setup. Okay, what then happens? The market comes in and liquidates us. Okay, and I'll explain this to you. It's nothing to be worried about. What happens sometimes is you also need to understand what's playing out here on the basis of orders in the market. Okay, so a lot of people have placed orders at this point, at this point, at this point, this point, this point, this point, this point, everywhere. Everywhere this market's moving, you've got orders being placed by somebody. Yeah? And there's multiple orders that are going in. Right? What the market does, it liquidates people to then fuel a bigger move to the downside. So it's taken out all of these guys at this point. So this market breaks here, these guys are out. This market breaks, these guys are out. It breaks here, these guys are out, these guys are out, these guys are out, these guys are out. The only people now left in this trade are people that got in very early. So what the market does, it comes to try and test their stop losses. And it takes some people out and some people stay safe, because some people may have their stop loss set way up here. They're just being safe. Okay? They're waiting for that higher time frame demand zone to get rejected. And even though it's 140 pips stop loss, they might be risking 1% for this. And they're risking $1,000 on this 140 pips, but they're hoping to make all of this way down to here. They're waiting for this to move all the way down to here, which is a 2,500 pip move. So their 140 pip stop loss is actually a 1 to 20 move. Okay, so what happens is the market comes back in, it tests this area again, and it takes people out that have got aggressive stop losses. So these guys that are setting their high above the previously protected lower time frame high end up getting liquidated at some point. Now, when I entered this trade here as my second confirmation, I would have taken 1 to 10 off the market already at this point. Okay, we spoke about this. But then what the market does is it comes and liquidates me out. Whatever additional trades I had running get taken. Right? It liquidates, but it's still respecting the lower time frame zone. So now what we do is, because it's respecting the lower time frame zone, we look for that setup again, and it happens again. Okay, so what happens again? We've got the high, rejection, it comes down, rejects, comes back and tests again. It doesn't test an area that I'd be comfortable entering, so I would not be in this trade. It breaks down again, comes back, tests again, nothing that I'm comfortable with. But then when it does this, it breaks the previous structural point with this wick down here. Okay, it's taken these lows, which now shows us bearish momentum. And then what it does, it comes back in and it then tests the wick that it left behind. Now, again, we're going to do exactly what we did the last time. We're going to go to this wick and we're going to mark 50%. Okay, so everything else gets deleted. We're only now concerned with what's happening here. Now, what happens? Another thing you need to bear in mind. This candle wicked up. Okay, it wicked up and it rejected and it broke structure to the downside here. So we've got a breaking structure. It comes back up, but it doesn't take 50% of the wick again. It doesn't need to, because what it's already done, it's taken a position off with this move. So it's taken 15-20% here, comes back in, and it takes the remaining 25-30% here. So with these two moves, it's taken 50%. Okay, so then we would be good to enter at this point. Why? Because we've got a bearish engulfing candle forming, where there's no wick and it takes the close of the candle and it starts moving away. We could enter here again like this. 7 pip stop loss, and we let the trade run, targeting what we would say are again structural points. Inefficiencies at a 1 to 8, and then lows at a 1 to 15. Okay, so let's see what happens, and then we'll go into the next stage. So this kind of gets taken. Now we're not interested in what happens. Let's see. So the market comes back up. Our stop loss is still safe here. Okay, continues to play around. When it comes back up into this level, you could actually also get in another entry here because it starts rejecting from that area again. The thing that doesn't make me confident in this trade is that it hasn't broken structure to the downside here, okay, which are alarm bells, which shows us that it might actually mitigate our position. But we're still monitoring the high that we basically use as being protected, or we could use this as an even higher point to see if it gets protected. The market continues to reject. It's now duping people into sell. So it's showing them, it's trying to show them that I've broken down, coming back up, I'm testing the entry again, and I'm moving away. But we can see what happens very soon after this. It gets taken out. Okay, so one of our trades would have been break even, no problem. We're now looking at this high to be respected. The market comes, it takes out the high, and it's taken out the lower time frame zone that we had marked up. We're still not concerned, okay, because as far as we are aware, it's taken liquidity from people here now that had sell orders. So these guys who were at this point, come on, selling here with their stop losses here, the market is now targeting those guys who were aggressive on this entry with small stop losses. Okay, so it's taken out anybody who had a 7 pip stop loss on that initial entry. But the guys that had the 50 pip stop losses, they're cool. Okay. Okay, so we play on. The market starts to reject, rejects again, and rejects again. Now, because the market started to reject again, we can go back to scenario 1, where we should have recalled back in the day that there was an aggressive entry here, which people were possibly in on, and those guys have now got taken out with an aggressive push through that zone. But it's just a liquidation of these stop losses. When it starts to reject from here again, we are still bearish because the zone, the higher time frame zone, has not been broken. So again, we go back to our game plan. 50%, does it get taken? Boom, gets taken. Okay, then we go again. 50% of the next candle, does it get taken? It's very, very close. Okay, so we could enter again at this point and set our stop loss above this one again. A 3 pip stop loss now. And as we're refining the strategy and we're getting to a more refined area where the market continually tests and wants to move off, we can see that our stop losses are getting tighter because the orders are getting less and the area that the market's interested in is getting refined. Okay, so let's say that we took this trade and we entered this in a few positions, one here and the other one being here, and then we'll have a third position which we would have just run for the hills. Okay, so we're targeting a 1 to 13, a 1 to 25, and 1 to 35. So we see what happens with this. Yeah, depending upon my appetite and what I kind of feel the market's going to be doing, I sometimes place 2, I sometimes place 3, I sometimes place 4. So boom, right? Our initial trade of 1 to 13 gets taken, and you can see that it's something that you got to be, you got to hold your nerve on because it does move away. You're in healthy profits here, about 1 to 10, okay? But it then starts to retrace and it tests your entry very, very, very closely, right? So we got within half a pip of our entry. But the market then respects the area and it moves away. It takes our initial trade, TP, 1 to 13, done. So now what we're going to do, we're going to break even the other trades, which were entered at this point, we'll break even, and this one will break even. Okay, these two are now risk-free trades. We're just going to see what happens. Boom. Okay, so this is the 1 to 25 also gets taken. 1 to 35, done. Thank you very much. And you could call it a week or that. But the week is, you know, it's still playing out. And this is how I kind of do the analysis just using the 1 hour. But it's the confidence of continually sticking to your plan. And having confidence that, look, until this zone is not broken, I am still bearish. Okay, and we can see what happens if we continue to play the market. Market took our 1 to 35. Continues down, continues down, continues down. And then... Yeah. So look, I mean, look, initially, what you want to do is get your mind attuned to only taking pro-trend trades. Don't even take the counter trend. Because if the monthly, the weekly, the daily is showing you that it wants to go bearish, only take the sells. And take the sells at areas that are confirmed with your trading plan. And I've pretty much shown you 70% of my trading plan right now. Exactly what I do. Okay? There's a whole heap of other stuff that I do on the lower time frame, which will really just confuse you, and I don't want to tell you that now because it'll get too complicated. Start with this. Use this as your initial confirmation strategy. See how it goes. Put the trades that you're taking into the group chat, and then we'll see exactly how it plays out. But, you know, stick very religiously to the trading plan. Don't change things around. Because if you start to do that, then you'll start to enter at points like this. Yeah, and you'll just get stopped out very quickly. If you use confirmations of it has to break structure. It has to break structure before it returns to a point that caused that break of structure. So like I said, this trade here was this point here. We were targeting this candle that moved to the downside, and we can see it came down, didn't break structure here. There's no reason for us to enter here because it hasn't entered our zone. Moved away again, came back down, broke structure here, and now we're interested in this trade. So it came back, it tapped into our zone, and then it broke away. And we take profits as the trade materializes. We're not waiting to hit a home run every single time. You don't want this to happen every single trade because, as we can see, sometimes it doesn't happen. But when we took this trade here, we're then looking to target here, here, and here. And all three of those got taken. So where you lose out on one, you'll have three that will take it, you know, to the out of the ballpark. And where you lost 1R on this trade, we've just automatically made back nearly 60R by sacrificing one. Okay, I hope that makes sense. What I will do is I'll basically upload this, and hopefully if you guys want to refer back to it, feel free. If you want to ask questions on top of that, feel free to do that as well. All right. Okay, no issues at all. Okay, guys. All right, no issues at all. All right. Speak soon. Okay, bye-bye.